All right, let's dive right into this explainer. Today we're unpacking a truly fascinating corporate evolution going on right now in the Asian energy sector. We're looking at a fresh investment briefing on China's Shenhua Energy. Now, if you follow this space, you already know Shenhua isn't just your run-of-the-mill coal company. They are a vertically integrated titan. They hold the title of China's absolute largest coal producer, sure, but they also manage this massive web of power generation, railway, port, and chemical assets. But here's why we're talking about them today. 2026 has brought a complete seismic shift to their operations, and we're going to map out exactly what that means for their future.
To make sense of this dense briefing, we're going to break the analysis down into 5 clear pillars. We'll start with that monumental shift in 2026, move into the financials and valuation, explore their strategic growth projects, weigh the risks against the rewards, and finally, land on the ultimate investment verdict.
Kicking things off with Part 1, a game-changing transformation.
Okay, we have to start with this landmark asset acquisition from their parent company, CHN Energy. To put this number into perspective, a staggering 133.6 billion renminbi price tag makes this the largest energy asset restructuring in Chinese corporate history, closing right in the first half of 2026. This single number really sets the stage for literally everything else we're going to discuss today. It's such a massive influx of capital and assets that you kind of have to completely reevaluate what China's Shenhua actually is.
Think about the before and after here. It perfectly illustrates this metamorphosis. Total reserves jumped about 65%, but more importantly, the recoverable reserves, the coal that can actually be mined economically, almost doubled, jumping from roughly 17.5 billion tons to an incredible 34.5 billion tons. And since production capacity is what actually drives the earnings, that capacity surged by a massive 57%, going from 327 million to 512 million tons. As the briefing points out, this single deal added more production capacity than many mid-sized coal companies possess in their entire portfolios.
But here is the real kicker. This wasn't just a pure coal play. Beyond the mines, the integration of these high-performing thermal power and coal chemical assets creates a combined entity with some seriously enhanced earnings power. The briefing is super explicit here. These aren't speculative or underperforming assets. They're expected to contribute over 9.4 billion renminbi in annual profit. And we actually started seeing the proof of this in the data as early as May 2026, where coal sales increased by 11.7% year-on-year, entirely thanks to these newly integrated volumes.
Moving right along to Section 2, Financials and Valuation Reality.
So the strategy sounds amazing, right? But we always have to look at how that actually translates to dollars and cents in a shifting macroeconomic environment. And that brings us to what we're calling the Q1 2026 paradox. Yes, coal sales volume actually went up by 3.9%, which helped push revenue up a modest 1.2% year-over-year. But net profit actually took an 11.1% dive. Why in the world did that happen? Well, a 3.8% drop in average selling prices compressed their margins super sharply. It's a perfect illustration of the operating leverage inherent in this business. Basically, when prices fall, your volume growth can just get entirely neutralized, and margins get squeezed way faster than top-line revenues.
Because of that intense price sensitivity, analysts are modeling what you might call a slow and steady grind over the next few years. Estimates are projecting an EPS of 2.86 renminbi in 2026, inching up just slightly to 2.93 in 2027, and then 2.99 in 2028. Now, this assumes coal prices stabilize, of course, but it really shows that despite swallowing a bunch of massive new assets, top-line earnings growth will likely be quite flat and modest, rather than some explosive upward curve. So, the crucial takeaway here is understanding exactly how the market is valuing this new reality. With a current PE ratio of 12.4x compared to its historical average of 10.1x, investors are straight up paying a premium for Shenhua right now. They're paying for that stability, that dominant market position, and the strategic value of the massive acquisition. And of course, they are highly tempted by that juicy 5.7% forward dividend yield. The company has committed to a minimum payout ratio of 65% all the way through 2027. But just a quick note of caution pulled straight from the briefing, while these dividends are well covered by earnings, sitting at about a 76% payout ratio, they might not be fully covered by free cash flow, and that is a totally vital metric to watch if you prioritize cash flow sustainability.
Let's jump into Part 3, Growth Projects and Technology.
While those financials tell us where the company is today, we definitely need to look at the operational projects driving its future. Right off the bat, the briefing notes that Shenhua's absolute top priority for 2026 is consolidation over aggressive expansion.
They are actively aiming for minimal production growth in the near term. And honestly, this is completely understandable. When you just absorbed a 133 billion renminbi acquisition, your immediate focus literally has to be on digesting that massive meal, integrating systems, and optimizing your newly expanded footprint.
However, they are simultaneously laying some pretty incredible groundwork for the future. First up, there's a 1 billion yuan investment for a new coal tech research institute in Hohhot, which is going to focus heavily on safe, green, and intelligent deep coal mining. Second, they just secured the earth-moving permit for the TT Mine expansion over in Mongolia's South Gobi province, a massive step for Sino-Mongolian energy cooperation. And third, they've established this highly cost-efficient new rail-to-water transport corridor from Xinjiang straight to Huanghua Port. What is absolutely brilliant about this is that the multimodal route utilizes the company's own rail lines, so they benefit from a 30% reduction in railway freight costs. It massively improves their domestic cost competitiveness.
Which brings us to Section 4, weighing the risks and rewards.
No investment analysis is complete without a completely sober look at what could go wrong. And the primary threats here are fundamentally rooted in price exposure. Think about it. If the broader economy slows down or the transition away from coal accelerates, Shenhua's revenues are going to face sustained pressure. We also have to acknowledge the ever-present risk of government policy and regulatory intervention. Things like pricing controls or production caps can create unpredictable volatility, right? Add to that the complex, very real execution risk of integrating all those new mines, power plants, and chemical facilities. And finally, like we touched on earlier, there is a very valid concern that the generous 65% minimum dividend payout ratio might stretch their free cash flow a bit too thin, which could force them to increase leverage if profits decline.
On the flip side, though, the rewards here are incredibly robust. I mean, you are looking at a company with truly unparalleled scale and vertical integration. They hold this deeply defensive, dominant market position in China's coal industry. And that 5.7% dividend yield, it's among the most attractive you'll find in the entire Asian energy sector right now. Furthermore, they are actually benefiting from major macroeconomic policy tailwinds. The government's latest 5-year plan actively favors production consolidation at massive industry-leading mines, which is exactly what Shenhua operates.
Finally, Section 5, the final investment verdict. So after looking at the sheer scale of the transformation, crunching the financials and weighing those risks, what's the big takeaway? Where does this leave us? Well, the consensus from the briefing is that Shenhua is undeniably a high-quality company, but it's operating in a structurally challenging sector. Crucially, the stock is currently priced for stability rather than explosive growth. So if you're an income-focused investor, this is really a play for a relatively secure yield, but it's one that demands strict monitoring. Ultimately, the success of this play hinges on 3 main things: how flawlessly they execute the integration of those massive new assets, their ability to actually maintain that generous dividend, and how smartly they navigate a flat to declining coal price environment. Which brings us to the ultimate question I want to leave you with today. The fundamentals are undeniably strong, the sheer scale of the company is unprecedented, and the yield is highly attractive in a low-yield environment. But integrating a 133 billion renminbi acquisition is an absolute operational mountain to climb. So, is that 5.7% yield worth it? I'll let you chew on that as you weigh Shenhua's defensive, dividend-paying dominance against the immense, real-world complexity of their new reality. Thanks for joining me on this explainer, and keep learning.